So it's been brought to my attention that the IRS pulled only what I can consider a little bit of a sneaky sneak. According to my understanding, basically everyone else's understanding, what's written in the CARES Act, all the stimulus packages for individuals and businesses are non-taxable. However, the IRS has released some documentation that says that might not actually be the case for Paycheck Protection loan recipients. And in this video, I'm going to go over the bulletin that they released and my summary of it, the most important parts of it. And I'm going to go over also an example of a business and the potential implications of how this will be taxed in the future. So going right into the IRS document that they released, I'll have it linked in the description if you want to take a look at it. I'm going to go over the important sections of it, and like I said, I'm going to summarize it and translate it into terms that are actually understandable because it's a bunch of like legal gobbledygook. So it starts off by saying that the Paycheck Protection loan proceeds can be used to pay for payroll costs, certain employee benefits regarding health care, interest on mortgage obligations, rent, mortgage payments, utilities, interest on any other existing debt obligations, and states that there might be loan forgiveness if spent on the right things. So we already know all that. Then it goes on to say, and I'm going to paraphrase this because the document barely even looks like English, any amount that a Paycheck Protection recipient receives in loan forgiveness under the loan forgiveness shall be excluded from gross income per the CARES Act, Section 1106I. So that's what we keep hearing. It's not taxable income. You receive it, you don't have to pay taxes on it. However, the IRS then goes and pulls an Uno reverse card and says, sure, we'll agree that it's not taxable income, but any expenses that the loan forgiveness is spent on cannot be deducted from tax. Meaning you pay taxes on those as if they were profit, as if those expenses never existed. So AKA, you're going to have to pay tax on any forgiven amount, whether they're going to call it that or not. So this kind of got me riled up because there's been so much talk about how no stimulus is going to be taxed, and the whole point of the stimulus is to stimulate the economy. It just doesn't make sense to me that you'd give $10 and then say, hey, give me back $2. Like, why not just give 8. So they state the reason that expenses are not tax deductible is it would result in a double tax benefit. Now this intuitively didn't make any sense to me. It seemed like there's no way that there would be a double benefit or no way to receive more than what's promised. It just, on face value, it didn't make any sense to me. So I got my irritated self to think this through and make some examples and scenarios so I could understand this and then I could explain it to you guys. So I'm going to bust out my whiteboard here. You guys were wondering what this thing was. Get this in position. We're going to do an example business. All right, so this business, let's say it does $1 million a year in revenue and does 10% profit. So that's 100,000 profit. And for all sakes of these examples, we're going to say, make sure that you can see that. We're going to say that there's a 25% tax rate, just to keep it simple. So 25% tax rate, 75K profit last year. So this is under normal circumstances. However, we're going to say that this imaginary business is down 20% this year due to COVID and all the craziness, and expenses are still $800,000. So we're going to say they're going to hit $800,000 in revenue this year, but expenses are $800,000. So they're looking at $0 in profit. They're going to break even year end. So this imaginary business, we're also saying that they received a $100,000 Paycheck Protection loan, forgivable loan. And in the first scenario, the Paycheck Protection loan has no limits with deductions or taxable income or anything like that. So we have $800,000 in revenue plus the $100,000 Paycheck Protection loan. So in this case, the $100,000 is now considered $100,000 in after-tax profit for the business. So this is equivalent to the business doing $900,000 in sales and profiting $100,000. But remember, this is after tax. So $100,000 after tax, you add in that 25% tax rate, is actually $125,000. So this is equivalent to the business doing $925,000 in sales and profiting $125,000. Which, if you go back to the first example, that's actually more, profiting $100,000. This is actually more than what it made in the good year last year. However, if we look at the same business and we talk in terms of them not being able to deduct the expenses under the Paycheck Protection. So we have this $800,000 business, they get the $100,000 Paycheck Protection loan, and in this scenario, that $100,000 is considered taxable income. So you take $100,000, so it's equivalent to the business doing $800,000 in revenue and makes a $100,000 profit. So they're paying taxes on $100,000 in profit, which equals $75,000 if we're considering a 25% tax rate in profit. So in the second scenario, with the net amount is not taxable, but the deductions are taxable, they're equivalent to the good year, the year before, at $75,000 in profit. So in this scenario, if that business was able to deduct expenses from profit, they would actually make more than they did in the good year. So this is when it started to click for me that, okay, there might actually be a double benefit. Basically what they're saying is, in a situation where you're making more money because of this loan, you won't get that double benefit. However, I made another example in which a business lost even more money. So we're going to erase this $800,000. And let's say this same business that did $1 million last year is now going to do $600,000. So they're down 40%. And their expenses are still $800,000. So they're on track to lose $200,000. Now, the same business still receives that $100,000 Paycheck Protection loan. And in this scenario, if the deductible items aren't the case, meaning that they can deduct those forgivable expenses from their taxes and it's non-taxable income, that would be equivalent to them doing $700,000 a year in revenue, because it's a $100,000 Paycheck Protection loan. If it's not taxed and you can take deductions, that is equivalent to them doing $700,000. However, their expenses are still $800,000, meaning they still lose $100,000. They're not going to pay taxes on that because you don't pay taxes on what you don't make. If this same business still lost 40% of its business at $600,000, the Paycheck Protection amount isn't included income, but the deductible amount is, meaning you can't deduct expenses that are forgiven from your taxes, and they receive that $100,000 Paycheck Protection loan. That would mean this business that does $600,000 gets the Paycheck Protection loan of $100,000. Their expenses are still $800,000. However, this $100,000 does not count against profit, meaning this is equivalent still to this business being in the same place. It's equivalent to the business still doing $600,000 in revenue and having $800,000 in expenses. However, they're really only losing $100,000 because of the loan, not $200,000. So if it's in a case where the business is going to lose money either way, there's really no implication from this change in guidelines, which I'm very happy about, because that means businesses that are losing money due to COVID aren't going to lose even more because of this tax scenario. It's really going to only affect the people who end up being in a situation where they profit more because of the Paycheck Protection loan. So I really hope that this example helps clear things up. I usually pride myself in being very good at explaining things, but this was a little bit of a doozy for me. So either way, apparently there's certain stipulations that allow the IRS to accept a double benefit. They have the power to do so. However, I'm not wholly familiar on how those scenarios exactly work, and I'm not going to expect that they're going to change anything so we can get this double tax benefit. And at the end of the day, I'll be happy even if I just receive a paycheck protection loan at all. And really, this is just a classic situation of if you promise someone 100 and you give them 75, they're going to be bummed out. But if you promise 75 all along and you gave them 75, they're going to be like, oh, that's great. However, why not just be the good guy and promise 70 and then give 75, and then the public loves you? There's the solution to all their problems, because this is going to make people angry. IRS, you're going to make people angry. Anyways, I'm curious, what are your guys' thoughts on this? I hope I did a good job of explaining it. I'll be curious to see what your thoughts are in the comments below. Until next time, I'd like to thank you for watching, and I hope you have a profitable day.